Tom Hoops, let's revisit the active versus passive investing debate, because a lot of people are saying that this is the year that active beats passive.
Yeah, thanks, Greg. A lot has been written and discussed about active versus passive. For us at Legg Mason, we like to think of it as active and passive, because I think well-diversified client portfolios should have a little of both. To us, it's constructing a portfolio with elements of both active and passive. We are primarily an active manager through our 7 affiliates. Performance across the Legg platform has been very strong. I think will continue to be strong. But again, I think some of the one versus the other is a little overblown.
Well, frankly, the lines are almost getting blurry because there's so many ways now to be both active and passive. You hear about smart beta and hedged currency. Can you talk about the shifting landscape of the mutual fund and the ETF world?
Sure. Let's take kind of active and take the alpha side of it with active and the beta side with passive separately. I think in active management, you're seeing it morph into almost 2 different businesses. One being more the historical, classic, traditional active business, a benchmark relative, Morningstar 9-box type of thing, and that's a fairly mature business. It's a big business, but it's fairly mature. We also are focused on what we're considering the next generation active, which are much more outcome-oriented solutions, things like multi-asset class and alternatives and unconstrained fixed income. That's very much a growth business. So from the mutual fund side of the world, on the active side, we continue to invest and grow our next generation active business. Same time, I think beta is changing as well. So we look at passive, historically it's been market cap weighted indexing. But I think clients and their advisors are starting to realize that there are some inherent problems and biases when you invest in a strategy that's market cap weighted. And so what you've now seen is a plethora of firms come out with ways to do beta better. And certainly I think it's an interesting space. It can provide clients better risk return outcomes. And so from that you see almost this middle ground, the smart beta, these rules-based investment plans, usually delivered through ETFs, that in some ways are better takes supposedly on market cap weighted, or they're more rules-based ways to capture active management risk premium.
Can we bring it back to the client once again? Because shouldn't the client be focused on their goals as opposed to beating a benchmark? Here on Wall Street, all we want to do is beat our benchmark. Maybe we get a higher bonus that way. But when you bring it back to the people that are actually investing, how should they do it? Shouldn't they be goals-oriented as opposed to benchmark-oriented?
Couldn't agree more. I mean, I think actually as an industry, we make it very difficult for clients and their advisors to sort through the myriad of products and all this, the wave of new products and innovation and so forth. I think you need to step back and you need to think about the main objectives. And I like to think of it as almost 3 primary colors, right? Capital preservation, income, and growth. And most client objectives can be met by blending 1, 2, or all 3 of those. Once that is set up, it's really up to the advisor and the client to then create a diversified portfolio within each one of those buckets. So for instance, for us last night, we announced acquisition of an infrastructure company in Australia. The product itself is interesting, but more interesting is what it can do for client objectives. And there are products that this firm has that help protect against inflation for capital protection, provide a diversified source of income for an income portfolio, and also offer growth in a less correlated way as well. So that's why we like the infrastructure space.
And that firm is based in Australia, right?
Sydney. Yeah.
All right, let's talk about international investing as the final question. Do Americans have enough in Asia, in Europe, in Japan right now, or are they too domestic oriented?
In our view, they're too domestic oriented. At Legg Mason, we do an annual global investor survey. We've done it now for 3 years. And as part of that, we look in aggregate at their asset allocation. And the odd thing is it hasn't changed much over 3 years. But probably more interestingly is the allocation to outside one's home market is only about 13%. And I think if you look at where global growth is and where returns are expected to be, clients need to look outside their own markets, really to look for other sources of return and other sources of growth.
All right, thanks a lot for coming on.
Thanks, Greg.
And thank you for watching The Street.